Okay, so we are going to start chapter 19. And I did put out, that'll be under unit 2, chapters 19 and 20. So today I did realize I didn't even have the PowerPoint out there, and I know you might like reviewing that. So I did put the PowerPoint out, a copy of these notes, and also the chapter 19 practice. So I added all that today when I realized I hadn't yet. So that's out there. And then, yes, I've been working on chapter 20, so you should see that. I'm hoping to get that done today. So you'll start seeing that. The adaptive learning plan is out there for chapter 20. And then I am working on the homework and the test. And then hopefully I can get the other few chapters done pretty quickly too. But we are ready for chapter 19, which is cost, volume, profit analysis. So I'm going to go ahead and open the chapter 19 practice. So go ahead and open that up. And I'll hit start assignment now. Do it. Okay. So cost, volume, profit analysis is really important. It sounds more complex than it is. If you kind of look over your notes, it's really a lot of formulas. So a lot of it's not too bad actually in this chapter. I find it a little easier, but it's very useful. So what we're going to do is kind of talk about the difference between variable and fixed costs and how that works, you know, in really looking at setting price points even. We won't get into that as much this chapter, but next chapter too when we talk about it more. But looking at, you know, like how many units do we need to sell to break even? And so then we would know, you know, if we sell anything more than that, then we're making a profit. And if we sell any less than that, then obviously we're coming up with a net loss. And then we can also look at, you know, how much sales do we need to have in order to make a certain amount of profit. So we are doing some calculations as far as that goes. Excuse me. And we're also going to do, we're really just going to focus on one method here as far as like actually finding, given some cost data, they're going to give us like level of production in units and our total costs. And we're going to learn how to take that data and figure out our variable and our fixed cost component. So our cost function is really important. And basically that's on the top of your notes here, the high-low method. We're going to do that in one problem, I think the next one. But the total cost function is really important in managerial accounting, and you'll just see that's total cost equals fixed cost plus the variable cost per unit times the units of production. So really, this high-low method is going to let us solve for the variable cost per unit and the fixed costs. And once we have those two costs, we can calculate our total costs at any level of production. So that's kind of the whole point of that cost function, is just knowing if we can solve, if we know what our fixed costs are and we know what our variable costs per unit are, then we can know our total costs at any level of production. And that's what this first one is kind of talking about, this relevant range and fixed and variable costs. So we know from previous chapters, you know, I think we covered variable costs anyway. Variable costs are like your materials, labor, and then variable overhead. Okay, product costs, variable product costs, our materials, labor, and variable overhead. So these are costs that go up the more we produce, right? We obviously are, it's going to take more labor, more materials, the more product we produce, okay? So those are variable costs. And then our fixed costs are our known costs every month, you know, like rent, depreciation, things like that, that stay the same every month for the most part. We can plan ahead, right? You know, utilities, rent, all of that stuff. So those are fixed costs. So what we're looking at in this chapter is, it is different, right? Because what we look at the most is variable cost per unit. It doesn't matter, you know, it's going to, the variable cost per unit stays the same. You know, if we're paying labor, for example, we may pay $10 an hour, right? So the variable cost increases the more we produce. Okay, so the more product we produce, variable costs are going to go up, right? because you're producing more product. You're taking more labor, more materials, more variable overhead. Your fixed costs are going to be the same for the period, regardless if you make 500 or 500,000. Okay. So when we look at that like an overall cost for the period, variable costs for the period increase the more we produce. Fixed costs stay the same. If we look at it on a per unit basis, though, variable costs stay the same per unit. You know, like labor and materials, we're going to pay $9 a pound for wood, regardless if we make 500 or 500,000. You know, variable cost per unit stays the same in a period. However, with our fixed costs, if we make more, we're actually spreading that unit cost, that unit fixed cost over more units. So our fixed cost per unit actually goes down when we produce more. Okay, so it's kind of a weird, it's almost like supply demand, but we're not getting into supply demand. But it's kind of like those curves, you know. So again, with fixed costs, they're the same period after period. But if we were to assign a fixed cost per unit, that fixed cost per unit is going to go down the more we make. Does that make sense? Okay. So we're going to look at it both ways. So we're going to look at like total cost for the period, and then we're going to break it down per unit. So that's kind of what this first one is illustrating, is we're looking at what we call a relevant range. So basically, if we have the costs for one range of production, we can figure the cost at any level of production, which is pretty cool. And the reason why is we know our total variable costs, we know how much our production is, and my cursor's in the way, but we know our total fixed costs. Well, when we're looking at total costs at any production level, our fixed costs stay the same. Okay, so we can fill that in. That's pretty easy. It's 810,000 of fixed costs at any level of production. You know, our rent's the same, generally utility charges, you know, things like that, depreciation on the equipment, all those fixed product costs are the same at any level of production. Okay, so those are fixed costs. Well, we can calculate our variable costs. So what do you think I would do to calculate my variable costs? I want to figure out what my variable costs are if I produce 60,000 units. Yeah, exactly. We're going to take our total variable costs and divide it by our production. And that'll give us our variable price per unit. Okay, our variable cost per unit. So what is my variable cost per unit? 30, good. I'm going to go ahead and pop this down as a per unit because it's there. Whoops, there we go. And again, with variable costing per unit stays the same. Okay, so that variable cost per unit is going to be the same at any level of production. So then what is my total variable cost if I made 60,000 memory chips? Very good, 1,800,000. We're just going to take 60,000 times $30 per unit. So 60,000 times the $30 variable cost per unit. If we make 60,000 memory chips, it's going to cost us 1,800,000 in variable plus the fixed of 810. And then we could get our total cost at that production level. So it's at 2,610,000. Just adding those together. So really, we just established a cost function, you know, for this company. Like if we said total cost, TC for total cost equals fixed, which is 810. That's our fixed. Plus our variable costs are $30 times units produced. So that's what we're doing. We're establishing a cost function. So I know we get into a little algebra, right? But it's not too bad because we're just plugging in. We could take any level of production, even if it's not on this relevant range. We could put 200,000 units in here and figure out our total variable and our total cost. Okay? So that's kind of the whole point of this total cost formula or function, is that once we are able to write a total cost formula, we could figure out our costs, both variable and fixed, and total costs at any level of production. Okay. So then we could do the same at the 75,000, right? We could take 75,000 times $30 per unit, and we get what, 2,250,000 for variable costs if we made 75,000 units. And again, we just add to get our total costs. So total cost if we made 75,000 memory chips would be 3,060,000. Okay.
Is our variable cost always going to be the same?
Yes. Yeah, your unit variable cost. Yeah, unit variable cost will always be the same, but your total variable cost will go up with production going up. Yeah. And then fixed cost is kind of the reverse of that. Your total fixed cost remains the same, but we're going to see our fixed cost per unit change. It's going to go down with production. That's why I wanted to do this exercise, because I thought it was very visual as far as understanding the cost function and the relationship between fixed and variable. So, and we can see that relationship. So with fixed cost per unit, basically what you're thinking is, well, I already have to pay rent and depreciation and all of this, right, every month. So I already have to pay 110 or 810,000 a month in costs. So the more I produce and the more I can sell, the more I can cover those fixed costs, right? It's going to be easier to cover those fixed costs. Kind of like looking at your own personal budget. You know what your rent, and you can estimate groceries and all that. You can figure out what your total costs are going to be. So you know, oh, okay, I need to make an income that's greater than my total cost. But you can know how much you need to make just to cover like those fixed costs. So the more you make, the more variable costs you can take on. Okay. So fixed cost per unit, we're truly just taking the total fixed cost divided by however many we produced. So at the 45,000 level of production, 810 divided by 45,000, what's my fixed cost per unit? Yeah, it's $18. Very good. $18. So then when I produce 45,000 units, my total unit cost is $48. Okay, $48. That's my total. These are product costs here. My total product cost is $48 per unit. If I produce 60,000, my fixed cost per unit changes. I now have 810,000 divided by 60,000 units, which is $13.50. So that drops my total cost per unit to $43.50. So the more units we produce, our total unit cost is going down. Makes sense, right? Because we're basically, again, you're taking that fixed cost and spreading it across more units. And then at the 75,000 level, my fixed cost per unit is $10.80. So then it drops even further to $40.80. Okay, so total cost per unit goes to $40.80. So obviously it would be in our best interest to produce more units, right? Because it's lowering our cost. What else would we need to consider though? We're producing more units. Not a cost factor. What else would be, can we just keep, we could produce more, right? Say we could produce 200,000 and lower our unit cost even more. Right, yeah, and why? Because, well, yeah. Exactly. We may not sell them. So, you know, this is just looking at relevant range. So they're saying this is a relevant range of sales. You know, we could produce and actually sell. You know, it might depend on the month, right? And we're going to learn in later chapters about budgeting and all of that. We're going to use this data, though, to set our sales price and to set our sales goal. But we have to look at how much we could actually sell. Because if we can only sell 50,000, we're going to actually lose money if we're producing 75, okay? So again, this is kind of the beginning part of the cost volume profit analysis. We're looking at just costs and how to set that up and try to, you know, look at, okay, well, what's our cost structure under different levels of production? But the production department themselves are going to come back and say, one, what we're able to produce, because, well, we may not be able to produce 200,000 units in a month, right? We may be limited for capacity. And then the sales department is going to come back and say how many we could actually sell. Okay. So all of those departments like work together in managerial. You know, as a cost accountant, I'm providing this data, and then the other managers are saying, okay, that's great. This is where we need to be. Okay. So just to kind of give you a heads up on that. So it's really important. So when we're looking at costs, again, you know, we're really just trying to find that total cost function. We're trying to establish that formula. We know our fixed costs, we know our variable cost per unit. We can calculate costs at any level of production. And obviously these are, you know, estimates because we know any of these costs could change, but we're going to assume that they're not changing. Okay, let's go to the next one. So on this next one, what we're actually trying to calculate is we're going to try to find, given the units produced and the total costs, we're going to determine or calculate a variable cost per unit and the total fixed costs. So with the high-low method, they only gave us like 3 units, like maybe, I don't know if this is years or, they didn't say. If this was years, this might be years, or this may be months of data. You could be given 3 months of data, you could be given 24 months of data. You're just given some kind of chart of data. You're always given production, and total costs. Okay? So what we're going to do is we're going to use the high-low method to actually calculate and figure out, basically to write that cost function. That's our end goal. Well, we already know total costs, right? We have that here. So we're going to learn how to use the high-low method to solve for variable costs and then actually solve for total fixed costs. Okay. So as you can see on your notes, the formula is we always take the change in cost divided by the change in units. Well, we always do that based on activity level. So what I do first is I look at whatever data they've given me and identify the highest level of activity as far as units produced and the lowest level of activity. Okay. Well, again, it's pretty easy when they give you 3, right? So obviously our highest level of activity is 120 units, and our lowest is 80,000. Okay, 120,000. So I'm going to use this line of data. When we produced 120,000, our costs were 32,120,000, and then I'm going to use the lowest, the 80,000, correlating with the 25,000 or 25,100,000. Always base it on the highest and lowest activity, not the price. A lot of times they're the same, but you may find that they aren't. So always go off of the activity level. Okay. So I've identified that my highest level of activity is at the 120,000, and my lowest is 80,000. So we are going to solve for variable costs. Okay. So using the high-low method, we do the change in cost. So I take the highest cost minus the lowest cost. So I would do 32,120,000 minus the lowest level of activity cost, so minus 25,100,000. And I'm going to divide that by the change in units. So I'm going to take my units at my highest level, 120,000, minus the units at my lowest, with 80,000. Okay. So you want to do that, you know, do your subtraction first. Okay. So I'm going to take my change in cost, the highest level minus the lowest level, divided by my change in units, the highest level minus the lowest level. So you should get, what, 7,020,000 units, or 7,020,000 in cost divided by 40,000 units. Okay. So what is the answer? What do you get all total?
What are you asking?
This whole formula. Yeah, 175.5. What that solves for is our variable cost per unit. Okay, that is our variable unit cost. Variable cost per unit. So we could pop that in here. Okay, variable cost per unit, $175.50. Okay. From there, once we solve our variable costs per unit, we can use any of these levels of production and total cost and plug them in to solve for a fixed cost. Again, a little bit of algebra. So basically, sorry, over here. Okay, so I want to write my cost equation. I'm going to use the low level, the 80,000 units and the total cost of 25,100,000. We could use the high level of activity, but I'm just picking the low. So I'm going to write what I know. Well, I know my total costs. You know, total cost again equal fixed plus variable unit times units. Okay. Well, I'm going to put what I know. So my total cost is 25,100,000. 25,100,000 in total costs. I want to solve for fixed costs, so I'm just going to put an F for fixed costs, or FC, plus, well, I just solved for my variable cost per unit. That's what we just got. 175.50, so $175.50 times 80,000 units. So I multiply that, 175.50 times 80,000. What's my total variable cost? Just these two.
14,040,000.
Yeah, very good. My total variable costs are 14,040,000. So to calculate fixed costs, I just need to do what? Subtract. Where the algebra comes in, right?
That's the part I like.
11,060,000.
Do what?
11,060,000.
Very good, 11,060,000. So to do this, I'm going to subtract the 14,040,000 from both sides. Obviously, that zeroes out. And you're right, it's 11,060,000 equals our fixed costs. So our total fixed cost, 11,060,000. Well, then we have a cost formula, don't we? We've calculated our fixed cost and our variable cost per unit. So if we had a production level that we wanted to calculate the total cost on, we could now. Because we know total cost equals the fixed of 11,060,000 plus variable cost per unit of 175.50 times the units produced. So now that we've done that high-low method to calculate the variable and fixed costs, and this is an estimate, this is using the data that they've given us, it's an estimate. We've solved for both variable cost per unit and total fixed cost. So now you could, any given unit of production, you could plug in here and get your total cost. So that's kind of the purpose of the high-low method. And again, there's other methods we won't do in here. There's like the method of least squares or regression, which you can run in Excel. We do that in cost accounting. It's a little bit harder, where you can maybe get a little more accurate data, because we're only given like 3 months or years worth of data. So the more data you have, the more accurate this is going to be, because this is an estimate. That's just what to keep in mind. But it's a pretty good estimate. So then in B, when it says based on part A, estimate the total cost for 115,000 units of production. Well, you're just plugging in right here 115,000. Okay. So you're taking 115,000 times 175.5, calculating total variable costs, and then adding in the 11,060,000 of fixed. Let's see, your total cost would then be 31,242,500. 31,242,500. Any questions on that one? It's a lot of steps, right? But it's like, as long as you remember the formula, and well, you don't really have to remember, as long as you remember how to apply the formula, it's just stepping through the steps. Okay, so if you just follow what we just did, it's not too bad. And you can easily kind of solve and find what our fixed costs and our variable costs would be. Okay. All right. Let's move on then. So that's where a lot of the calculations come from. This chapter it's just a lot of math, really. This next one, we're kind of looking at more of ratios and margins. So it's talking about contribution margin. I put on here on your notes just what contribution margin is, like more of like from an income statement look too, because basically we're going to look at this even more next chapter, variable costing. But basically what you're looking at, you'll see it kind of down here. If we take sales minus our variable costs, that's our contribution margin. Okay, so that's the money we have to cover our fixed costs. That's what you want to think of. Contribution margin is the money we make that we need to cover our fixed costs. So when I think about it, when I'm thinking about production and everything, I want my contribution margin to be higher than my fixed costs. Okay, it has to cover my fixed costs for me to make a profit. So really, any contribution margin that's greater than our fixed costs is going to result in a profit. And so that's kind of why we look at it a little differently. Normally we take sales minus cost of goods sold, right? So this is just a little bit different way. Your income is the same, regardless of how we calculate it. We're just looking at the contribution margin. So that just kind of lets you kind of know why it's important to calculate. And again, when we move into next chapter, we'll kind of still focus on the difference between the two costing scenarios. But this one, we're going to calculate contribution margin ratios. And as you can see in your notes, you can do a contribution margin per unit, and you can do a contribution margin ratio. So it just gives you both options. Contribution margin per unit, you just take your selling price divided by your total variable price per unit. Selling price per unit minus variable price per unit, or variable cost per unit. To do a ratio, you then take your contribution margin per unit divided by your selling price per unit. Okay. On this one, we're going to calculate our contribution margin first. If we don't, they don't give it to us in units though, so we're going to do it in dollars. So yeah, I don't have that on the notes, I guess, that you can also do a contribution margin in dollars. So yeah, on this one, since they give it to us in total dollars, our contribution margin is always sales minus variable costs. Okay, so contribution margin here, we're going to turn it into a percentage. We have to first calculate it as just a contribution margin. So yeah, that's where it gets a little tricky because they're asking for it as a contribution margin ratio. Well, if you look on your notes to do the contribution margin ratio, you have to know the contribution margin per unit. Or in this case, we're just going to do it in total sales dollars. Okay. So what we're going to do is we're going to calculate our contribution margin first, which in this case is sales minus variable costs. Okay. Contribution margin is always sales minus variable costs. Sorry, I didn't put that on the notes, that it could be in total dollars as well. So we take 112,900,000 minus 66,611,000. So what's my contribution margin in dollars?
46,289,000.
Very good. 46,289,000. Well, when I'm looking at this, if you kind of look at your notes as far as like, sales minus variable cost equal contribution margin, which is what we just did, minus fixed cost equal income. Well, if our contribution margin is 46,289,000, we're going to make a profit, right? Because our fixed costs are only 25 million. Okay? Just as taking it a step further. But then to calculate the contribution margin ratio, we're actually going to take that 46,000 or million, sorry, 289,000 and divide it by total sales. Okay. So 46,289,000 divided by 112,900,000. How much? 41%. Very good. So we have a contribution margin ratio of 41%. Okay. So again, we can do it in whole dollars or in units, just depending on how they give it to us. So part B says, well, if the contribution margin ratio is 40%, we just calculate 41, but they're saying if it's 40%, sales were 34,800,000, fixed costs are 1,500,000. What is the income from operations? Well, what you're going to do is we're given it in percentage here. You're actually going to take your sales, let me write it on the board.
What did we divide the 46 million by? 41%?
Oh, by sales.
Oh.
Yeah. I left it over here. I left my eraser over here. I don't even know. Yeah, so contribution margin ratio is always contribution margin divided by sales. Well, once we have the contribution margin ratio, we can then calculate, we also have fixed sales, we can calculate our income from operations, okay? And I'm just kind of following that little formula under the contribution margin. So we have sales of 34,800,000. Our contribution margin ratio is 40%. So to solve for my contribution margin, I'm taking my total sales times the contribution margin ratio of 40%. That's going to be my contribution margin. So 13,920,000 is my contribution margin.
But whenever you say contribution margin, you're talking per unit. Unless you specify the ratio, right?
Correct. Yeah, this one is actually the total contribution margin in dollars.
Oh.
Because we're using the contribution margin ratio. So yeah, this one's a little tricky. Like I said on my notes, I should have included, you can do it in total dollars and not just in units. But the formula is the same. If you're doing total dollars, you just leave off the in units. So contribution margin equals sales minus variable costs. Okay. So in this scenario, when our sales were 34,800,000 and our contribution margin ratio is 40,000, my contribution margin would be 13,920,000. Okay, so that's my contribution margin. But they want to know income from operations. Well, basically what this contribution margin is, if you remember, is sales minus variable costs. Okay, so all I have to do then is subtract out my fixed costs. Okay. Our contribution margin is sales minus variable costs. Well, we were able to calculate it if we're given the contribution margin ratio. So basically, if you're looking at that, if we're looking at it, basically what it's saying is that our variable costs are like 60% of our sales. Okay. So the other 40%, what's remaining, the 13,920,000, is what we have after all of our variable costs. And then we just subtract out our fixed costs. Okay. So in this case, we have income from operations of 12,420,000. Okay. So again, when we get a contribution margin, that's how much we have to cover our fixed costs. Anything beyond that, anything after we take out fixed costs is all profit. Okay. It's just a different way of looking at it. So when we're looking at these variable costing and everything, this is very managerial driven, because we know if we were doing financial accounting, we would be doing sales minus cost of goods sold equal gross profit minus the selling and administrative expenses. Okay, so that's the difference here. We're just looking at it in a different light. Okay, so that, and we'll look at this next chapter too. We'll go into it even more. Yeah. So that's for reporting, financial purposes, where we have to do sales minus cost of goods sold. This is more important from a managerial standpoint because we know our fixed costs. Yes, it absolutely is. So from a managerial standpoint, it's more important to know our contribution margin and to be able to budget and plan. A lot of this is also for planning and controlling costs because we know our fixed costs. So we know, again, any contribution margin higher than 1,500,000 is going to result in a profit. So that's kind of helpful to know. So the whole cost volume profit analysis that we're doing, that's what we're doing, is we're able to analyze costs and cost functions. And that way, from a decision-making standpoint, we can see, you know, well, how much will it take that we make to actually cover all of our costs? Well, we know any contribution margin over 1,500,000 results in a profit, and so that's helpful to us. So that'll help us calculate. We'll do that next, like break-even point, and then even target sales. So we can calculate if they say our goal, if you know, sales comes back or the CEO comes back and says, well, we need a profit of $1 million this year. The accountant can go back and calculate how many units of sales that'll take to get there. Okay. So that's kind of the whole point. So we do this for budgeting, and we also do it to control costs as well. Because we might look at that then and be like, well, we need to figure something out. What if we can't sell that many, or we can't produce that many, or whatever? then maybe we need to look at changing our cost, or maybe we need to up our price. You know, really all of this is kind of setting the framework for making decisions later as far as price points and controlling costs. So maybe we can find a supplier that'll give us a better deal on materials.
That's the fixed cost or variable?
That'll be a variable cost, yeah. So maybe we could, you know, because if we increase that contribution margin, we have more money to cover our fixed costs.
Fixed cost.
Yeah, fixed cost rent, depreciation, supervisor salaries, stuff like that that we can't really, you know, can fixed costs change? They can, but for the most part, you know, we're probably going to look at making changes to our variable costing structure. That's kind of why, from a managerial standpoint, variable costing is important for, again, budgeting, planning, controlling costs. And we'll do even, like I said, 19 and 20 kind of go right along together. So in chapter 20, we'll even look at that more, why we use variable costing from a managerial standpoint. If you're doing financial accounting, you have to use what we call full absorption costing, which is the standard sales minus cost of goods sold equal gross profit. But for managerial accounting, it's all internal use, so we can use whatever we want. That makes sense, I guess. We can't just, you know, use whatever we want. Be like, I want a target profit of $5 million. That's how my daughter states numbers, you know. Do it. That's doing pretty well, right? Yeah, I'm like, I'll take that. Okay. So that's just calculating contribution margin ratio. Because as you'll notice in your other formulas, if for break even and then target income, we need to know our contribution margin, either unit or ratio. So this is when we're going to do break even. And turn to it. So it says for the current year ended October 31st, Friedman Company expects fixed costs of $14,300,000, a unit variable cost of $250,000, and a unit selling price of I'm saying thousands. $250. And a unit selling price of $380. That one threw me off all those millions, right? Like functioning in thousands and millions. So what we want to calculate is the anticipated break-even point, okay? Well, if you notice on your notes, break-even in units, which is what we're doing first, you're truly going to take your fixed costs and divide it by your contribution margin per unit. So again, when we look over there, it makes sense, right? Basically what we're saying is in order to break even, we have to cover our fixed costs. So in that example over on the right, we would have needed our contribution margin to be $1,500,000 to break even, to make no profit, right? We didn't earn a profit, but we didn't lose money. So to calculate break even, we take fixed costs divided by contribution margin per unit. Well, again, we just have to calculate contribution margin per unit. So sales of $380 per unit minus variable cost of $250. So my contribution margin would be sell price of $380 minus variable cost of $250. So $130, right? All I have to do then is take my $14,300,000 divided by $130. Do it. Right? When you just have a formula to plug in, it's not too bad. So how many units do we need to sell to break even? 110,000, good. So in order to break even, we would need to sell 110,000 units. Okay. And we could do, you know, our little income from operations to kind of verify that. We're not going to. And then on part B, it says we'll compute the sales, or units in this case, the sales in units required to realize income from operations of $2,405,000. Well, there you're going to do one of the formulas at the bottom. We want unit sales at target income. So all we're doing there is we're going to take our fixed costs plus our target income fixed cost plus target income, and divide by that same contribution margin per unit. So fixed cost of $14,300,000 plus our target income of $2,405,000, and you're still going to divide by 130, that contribution margin per unit. So how many units would we need to sell in order to get income of $2,405,000?
2,515,000.
That may be.
You gotta divide by 130. Oh wait. Is the 14 million plus the 2 million, and then you divide that by 130.
130, yeah.
And you give you 175.
Maybe left off a zero. Or added a zero, yeah. I've done that so many times with the millions. Yeah.
That's why I hate this thin gauge thing. Whenever they have part of your problem at the top, you pay for the bottom.
Yes.
This $1 million number.
It is frustrating. Yeah, so it should be, yeah, the 14,300,000 plus 2,405,000, and then divide by 130.
Yeah, I added a zero.
Okay, yeah, that'll do it. I've done it too, and I'm like, wait. But yeah, it should be, what, the 128,500? Should take 128,500 units to make an income of 2,405,000. So to do target income, you're just taking fixed cost plus that target income divided by contribution margin per unit. So yeah, those are just simple computations. It's just, yeah, making sure it becomes complicated when it's in millions. It really does. I'm always counting zeros when I'm putting it in my calculator, you know, because you don't have the commas there. It's like, what? See. Oh, we're already on the last one. Woohoo! As you can see in the first part, we're still doing break even and target profit. But then after that, we're going to talk about this cost volume profit chart. We're really not going to do a cost volume profit chart. We're just going to look at break even. But you can do it in a chart. I'm not very good at drawing charts on the board. Mine would not be accurate. But we'll kind of talk about that in a minute. But this first part, we're really just doing the same thing we did. So it says for the coming year, Cleve's company anticipated a unit selling price of 100, a variable cost of 60, and fixed cost of 480,000. So we're doing break even in units. So again, we need to calculate contribution margin. That one's easy, 100 minus 60. So $40 is our contribution margin per unit. So we're just going to take our fixed cost of 480,000 divided by $40 per unit. So that one's nice and even too, right? It should be 12,000 units. So we would need to make and sell 12,000 units in order to break even. And then again, we're doing target sales here. So we would take, to compute the sales in units required to realize target profit, 480,000 plus 240,000 divided by 40. Okay, so 480,000 plus 240,000, and then divided by that same $40 contribution margin. So how many units would we need to sell to get a profit of 240,000? 18,000. Good. It would take 18,000 units to reach a target profit of 240,000. So number 3 sounds really confusing. It's really not. Okay. It looks worse than it is. Sorry, just like lost my train of thought. And really what we're looking at there is we're looking at break even still. So what we would look at is it says construct a cost volume profit chart assuming maximum sales of 20,000 units within the relevant range. So what it's asking us is, these are sales, total sales levels. You know, would we break even, would we lose money, or would we turn a profit given these sales levels? So to construct that, we're just actually going to look at, you know, our break even. Let's see. So we know our break even is 12,000 units, right? Do what? It's not on? Oh, it won't. I'm sharing the screen, so it actually works, yeah. I'm like, well, oh no. I did that in class like a couple weeks ago in the college accounting. They just heard my voice. There was no like screen share. They're like, well, we at least heard you. I'm like, well, hey. So in this one, we've already calculated our break even is 12,000 units, right? So basically what we're looking at here is we know anything that we produce and sell over 12,000 units will result in profit. Well, what they're giving us is sales amount. Well, if I took 1,200,000 divided by the selling price of 100, that would tell me how many units that I sold, right? So at 1,200,000, I sold 12,000 units, right? 1,200,000 divided by selling price of 100. So basically what I'm looking at here is I'm looking at, that's my break even in sales, isn't it? If I took 12,000 units times a $100 sales price, at break even, my sales would be 1,200,000. So you could make a chart and line that up and say, you know, at 12,000 units, we're making a profit or sales of 1,200,000. Anything above that is going to be profit. Anything below, we're losing money. So this one they made really easy. Well, 1,200,000 is break even. It's break even. All these others are below that point, right? We're producing less. We're making less sales. So those are all losses. I don't know why they couldn't throw us a profit, but when we have sales of 1,200,000, we're going to break even. So anything below that is going to be a loss. And your book does show that like on a chart, you know, where you can actually chart that and visualize it more. But I just took, well, what's my break even in sales dollars? 12,000 units times the $100 sale price. Okay. So break even, everything else a loss. And then number 4 says determine the probable income or loss from operations if sales total 16,000. Well, do you think it's going to be an income or a loss? Why? I'm like, I don't know. 50-50 shot, right? Right, yeah, that's actually true. It will be a profit because anything above 12,000 units will be a profit. 12,000 is our break-even point. So anything that we produce and sell above 12,000 units will result in income. So to calculate what our income actually is, we need to take our sales, 16,000 units times $100. So the sales would be 16 million, or no, I'm sorry, 1,600,000. I'll write this one down. Okay. So sales, 16,000 times 100. So 1,600,000. We're going to subtract out our costs. So we're going to subtract out our variable costs. I think I need to scroll back up a little bit. So I'm going to calculate my total variable costs and then subtract out my fixed costs as well. So I would know my variable costs are 16,000 units times $60. So variable is 960,000. Okay. That would get me my contribution margin. Is that right? Yeah. 640,000 minus my fixed cost they gave us at 480,000, or yeah, 480,000. So I take my sales minus my variable costs. $640,000 minus fixed cost of 480,000. So my income from operations, if I sold 16,000 units, would be 160,000. Okay. And that's given the cost that they gave us. Any questions on that one? Okay. Any questions on chapter 19 so far? It's not too bad. I think it's probably one of the easier ones, especially what I assigned, hopefully. So yeah, just be working on chapter 19 homework, and then next week we'll look at chapter 20, which will look at variable versus full absorption costing. So we'll kind of use a lot of these same, you know, the variable costing, contribution margin, all of that will still be carrying over into chapter 20.